Canadian federal government has announced significant changes to the tax system for 2024, with a particular focus on increasing capital gains inclusion rate. Starting June 25th, 2024, the inclusion rate for capital gains will rise from the current 50% to two-thirds, or 66.67%, for corporations and trusts, and for individuals on gains exceeding $250,000 annually. This change aims to increase tax revenue by ensuring that larger portion of capital gains is subject to taxation. Increase in the capital gains inclusion rate will have substantial financial implications for high net worth individuals, corporations, and trusts. Individuals will face higher tax liabilities on their investment income, particularly for large capital gains. Corporations and trusts, which often realize significant capital gains, will also see an increase in their taxable income. These changes necessitate a reevaluation of investment strategies and tax planning to mitigate the impact of higher taxes. As of now, 50% of the capital gains are included in taxable income. This means that only half of the profit earned from the sale of an asset, such as stocks, bonds, or real estate, is subject to taxation under the current rules. Starting June 25th, the inclusion rate for capital gains will increase to two-thirds, or 66.67%, for corporations and trusts, and for individuals on gains exceeding $250,000 annually. This change means that the larger portion of the profit from the sales of an asset will be taxable, resulting in a higher overall tax liabilities for those who realize significant capital gains. This increase is intended to ensure that wealthier individuals and entities contributing to a larger share of their investment earnings to federal revenues, aligning with broader efforts to address income inequality and fund public services. Individuals will continue to benefit from the 50% inclusion rate on the first $250,000 of capital gains realized each year. This means that for capital gains up to $250,000, only half of the gain will be subject to tax. However, any gain above this threshold will be taxed at a higher inclusion rate of two-thirds, a significant increase in the taxable amount for large capital gains. To mitigate the impact of the increased inclusion rate on specific high-value asset sales, the lifetime capital gains exemption will be increased from $1,016,836 to $1.25 million. This exemption applies to qualified small business corporate shares and qualified farm or fishing property. Effective June 21st, this change provides some relief for taxpayers selling eligible assets by allowing them to exclude a larger portion of their gains from taxable income. Now, these adjustments are intended to balance the increased tax burden with targeted relief for certain types of investments, supporting small business owners and farmers while ensuring substantial gains contribute more sufficiently to federal revenues. High net worth individuals will experience significantly higher taxes on capital gains exceeding $250,000 due to the increased inclusion rate of two-thirds. This change will evaluate the taxable portion of their gains from 50% to 66.67%, resulting in a greater overall tax liability. To manage this increased tax burden efficiently, strategic tax planning becomes essential. This might involve deferring gains, utilizing tax-advantaged accounts, or considering the timing of sales to stay within the lower inclusion rate threshold, which means you have to sell right now. Adjusting charitable giving strategies can help mitigate the impact of the increased capital gains tax. High net worth individuals can leverage donor-advised funds to time their charitable contributions strategically, maximizing tax deductions. This approach allows donors to make charitable contributions when their taxable income will be the highest, thereby reducing their tax liability while supporting their philanthropic goals. Additionally, gifting appreciated assets directly to charities can help avoid capital gains taxes on those assets further optimizing tax outcomes if you want to give your stuff away, which is great. Starting June 25th, corporations will be subject to the new two-thirds inclusion rate on all capital gains realized. This means that 66.67% of the profits from the sale of capital assets will be included in their taxable income, up from the current 50%. This change is expected to increase the overall tax liabilities for corporations, particularly those that frequently realize substantial capital gains. As a result, corporations may need to reevaluate their investment decisions and the timing of their asset sales to manage the increased tax burden effectively. With the higher inclusion rate, corporations will need to reassess their investment portfolios and financial planning strategies. This may involve shifting investments toward assets that offer better tax efficiency or deferring the sale of certain assets to optimize tax outcomes. Additionally, corporations might explore alternative investment vehicles and strategies that can mitigate the impact of the higher capital gains tax, such as tax-deferred growth opportunities or reinvesting gains into tax-advantaged assets. Alternatively, corporations may look into moving their assets into jurisdictions with low or no capital gains tax. Careful planning and strategic adjustments will be crucial to minimizing the financial impact of this new tax regulations. Trusts will also be affected by the increase in the capital gains inclusion rate to two-thirds. This means that 66.67% of the capital gains realized by a trust will be included in the taxable income distributed to beneficiaries, up from the current 50%. This change will significantly impact the tax liabilities of beneficiaries, potentially reducing the after-tax distributions they receive. Trust managers will need to adjust their strategies for managing and distributing trust income to maximize the tax burden on the beneficiaries. The increase in capital gains inclusion rate necessitates a revision of estate plans to ensure all tax liabilities on inherited assets are minimized. Estate planners will need to consider the timing of the asset sales, the use of trusts, and other strategies to mitigate the impact of the higher taxes of capital gains. By proactively adjusting estate plans, it is possible to reduce the tax burden on the heirs and to ensure that the intended beneficiaries of the estate are preserved. This may involve exploring options such as gifting appreciated assets during the guarantor's lifetime or utilizing life insurance to cover potential tax liabilities. The inclusion rate determines the portion of the capital gains that is subject to income tax. Currently, 50% of the capital gains realized from the sale of assets such as stocks, real estate, and other investments are included in taxable income. Starting June 25th, that inclusion rate will increase to two-thirds, 66.67%. This change means that a larger portion of the profit from the sale of capital assets will be subject to income tax, effectively raising the tax rate of these gains. For example, if an individual realizes a capital gains of $300,000 under the current rate, $150,000 is taxable. Under the new rate, $200,000 is taxable of that gain, which will increase potentially overall their personal income tax as well. To manage the transition to the new inclusion rate, specific rules have been established. Capital gains realized before June 25th, 2024 will continue to be taxed at the current inclusion rate of 50%. Any gains realized on or after this date will be subject to the new two-thirds inclusion rate, which means you have to sell now. This transitional rules are designed to ensure that the gains are appropriately categorized and taxed according to the applicable rates at the time they are realized. This approach helps provide clarity and fairness for taxpayers who may have planned transactions based on the existing tax framework. Understanding these mechanics and transition rules is crucial for individuals, corporations, and trusts to effectively navigate the new tax landscape and make informed decisions about asset sales, transferring to non-tax jurisdictions, and tax planning. The increase in the capital gains inclusion rate to two-thirds starting June 25th represents a significant shift in the Canadian tax landscape. This change will be substantially high impact for the high net worth individuals, corporations, and trusts by increasing their tax liabilities on realized capital gains, necessitating strategic tax planning to manage these increased burdens. Corporations will need to reassess their investment strategies, timing of asset sales, and the jurisdictions to optimize their tax outcomes. Trusts will also have to adjust their income distribution strategies and revise state plans to account for the higher inclusion rate, ensuring that beneficiaries are not unduly burdened by this increased taxes. Given the complexity and significant impact of these tax changes, it is crucial for taxpayers to seek professional advice. We can help navigate these changes effectively, optimize tax strategies, and minimize tax liabilities under these new rules. Professional guidance is essential to understand the full implications of the increased capital gains inclusion rate and to implement proactive measures that align with your individual or organizational financial goals. By staying informed and consulting with experts like us, you can better manage your financial affairs and make more informed decisions will help you mitigate the impact of these tax changes.